Before we get into the RBI's latest move, let's quickly break down what interest rates actually are. You've probably heard the term 100 times on the news or in conversations about loans, but what does it really mean for you, for businesses, and for the country as a whole? Think of interest rates as the price you pay to borrow money, whether it's for a car, a home, or a business. It's like a fee that banks charge you for letting you use their money, and it's also the reward you get when you save money in a bank account. So, interest rates affect both borrowers and savers, shaping the choices we make every day. The central bank, the RBI, sets a key rate called the repo rate, the rate at which it lends to commercial banks. This isn't just a random number, it's carefully decided after analyzing the economy's needs and challenges. This repo rate acts as a master switch, influencing all other interest rates in the economy. When the RBI tweaks this rate, it's like adjusting the volume on the entire financial system, making money either more expensive or cheaper to borrow. When the RBI lowers the repo rate, it becomes cheaper for banks to borrow, and they're expected to pass on those savings to you and me. This means lower EMIs on loans, more affordable credit cards, and sometimes even better deals on home or car loans. Cheaper loans mean more spending and investment, which can boost economic growth. People might buy new homes, businesses might expand, and companies could hire more workers, all thanks to easier access to money. But if inflation is rising too fast, the RBI can raise rates to make borrowing more expensive, cooling down the economy. Higher rates can slow down spending, which helps keep prices from spiraling out of control. The RBI's Monetary Policy Committee meets regularly to decide whether to raise, lower, or hold the rate, based on data like inflation, growth, and global trends. They look at everything from oil prices to job numbers, trying to predict what's best for the country. Their main job, keep prices stable while supporting growth, is a tricky balancing act. If they get it wrong, it can mean either runaway inflation or a sluggish economy, both of which hurt ordinary people. Every rate change sends ripples through the economy, affecting everything from your home loan EMI to the price of groceries. Even small changes can have a big impact on your monthly budget and the cost of living. So, when you hear about the RBI changing rates, remember, it's not just financial jargon, it impacts your daily life. Whether you're planning to buy a new phone on EMI or save for your child's education, interest rates play a role. Understanding interest rates is the first step to making sense of the bigger economic picture. It helps you make smarter decisions about borrowing, saving, and investing. And it's why the RBI's decisions matter to all of us. No matter where we live or what we do, these choices shape the financial future of every Indian household. On December 5, 2025, the Reserve Bank of India's Monetary Policy Committee made a significant move by cutting the repo rate by 25 basis points, from 5.50% to 5.25%. This decision came after months of careful analysis and debate, reflecting the central bank's ongoing efforts to balance growth and inflation. In simple terms, this means borrowing becomes a bit cheaper for banks, which should, in turn, make loans more affordable for businesses and individuals across the country. The hope is that this will encourage spending and investment, giving the economy a gentle push forward. The fact that the decision was unanimous among committee members signals strong confidence in the current direction of the Indian economy. It shows that the RBI believes the time is right for a modest boost, without risking financial stability. However, the RBI also chose to maintain a neutral policy stance. This means the central bank isn't committing to more rate cuts or hikes in the near future. It's keeping all options on the table. This flexibility is crucial. By not locking itself into a particular path, the RBI can respond quickly to new economic data, whether that means providing more support if growth slows, or tightening policy if inflation heats up. A neutral stance sends a clear message. We're watching the situation closely, and we're prepared to act decisively if circumstances change. For example, if inflation unexpectedly spikes, the RBI could raise rates to keep prices in check and protect consumers' purchasing power. On the other hand, if economic growth falters or global conditions worsen, another rate cut could be on the table to support recovery and jobs. This strategic ambiguity helps the RBI manage market expectations and maintain its credibility as a steady hand in uncertain times. The combination of a rate cut and a neutral stance demonstrates a central bank that's proactive, yet cautious, ready to support growth, but not at the expense of stability. Ultimately, it's about nurturing economic momentum while keeping a close eye on potential risks, both at home and abroad. By keeping its options open, the RBI is signaling that it's prepared for whatever challenges or opportunities the future may bring. Alongside its rate decision, the RBI released new forecasts for inflation and growth. The big news: inflation is now expected at just 2% for the year, down from 2.6%. This gives the RBI room to focus on growth, since price pressures are under control. On growth, the RBI is more optimistic too, raising its GDP forecast to 7.3% for 2025 to 26, up from 6.8%. Quarterly projections show strong momentum continuing into next year. The message: inflation is tamed, growth is accelerating, and the RBI wants to keep the engine running hot. By cutting rates while upgrading its growth outlook, the RBI is doubling down on India's economic resilience. The goal: more jobs, higher incomes, and a stronger economy for everyone. These forecasts reveal the RBI's confidence and its strategy to press the advantage. Now is the time to build on this positive momentum. The RBI's recent rate cut is not just a routine policy move, it's a decision firmly anchored in robust economic data. India's economy surged by 8.2% in the July-September quarter, marking the fastest pace of growth in the last year and a half. This impressive performance has caught the attention of global investors and policymakers alike, signaling that India is on a strong upward trajectory. This growth isn't limited to just one sector. Consumer spending is on the rise, with people shopping more and businesses seeing higher demand. Manufacturing is also powering ahead, with factories running at higher capacities and new orders coming in. Private investment is picking up as well, with new projects breaking ground and companies expanding their operations to meet future demand. All of this points to a growing sense of optimism among both businesses and households. People are feeling more secure about their jobs and finances, and entrepreneurs are willing to take calculated risks. At the same time, inflation has cooled more than most experts predicted, dropping to levels that give the RBI much-needed flexibility. This rare combination of strong growth and subdued inflation is a sweet spot for any central bank. If inflation were still running high, the RBI would have been forced to keep interest rates elevated, even if it meant slowing down the economy and risking jobs. But with prices now stable and under control, the central bank can focus on nurturing growth and supporting new opportunities, rather than constantly battling rising costs. The rate cut isn't a quick fix for a crisis. It's a strategic move designed to lock in recent gains and keep the positive momentum going strong. The RBI is now shifting its approach, moving away from emergency measures and towards supporting a self-sustaining, resilient recovery. The central bank's goal is clear: to ensure that this strong growth story continues, while keeping a close watch so that inflation doesn't sneak back in and disrupt progress. It's a carefully calculated step, aimed at securing India's economic upswing and building confidence for the future. With this move, the RBI is signaling its commitment to keeping the good times rolling, responsibly, and with an eye on long-term stability.
In my press conference, I called this a Goldilocks moment for India's economy.
That means growth is strong, but inflation is low, a rare sweet spot for policymakers.
We're seeing robust GDP growth and sharp disinflation at the same time.
This combination gives the RBI a unique window to act proactively, not reactively.
The rate cut isn't a desperate move. It's a boost to an already healthy economy.
But Goldilocks periods don't last forever. External shocks can quickly upset the balance.
The recent rupee volatility is a reminder of those risks.
For now, the RBI is taking advantage of this ideal moment to strengthen the economy further. The message: enjoy the balance, but stay alert for change. Beyond cutting rates, the RBI also announced measures to keep money flowing smoothly through the economy. One big move: open market operations worth up to 1 trillion rupees, injecting cash into banks by buying government bonds. This makes it easier and cheaper for banks to lend, supporting businesses and consumers. The RBI also launched a $5 billion rupee swap, injecting more rupee liquidity and helping stabilize the currency. These steps ensure the rate cut actually reaches borrowers, not just banks. If banks are short on funds, they can't pass on lower rates. So liquidity is key. The RBI is combining lower rates with ample liquidity to maximize the impact. It's a behind-the-scenes push to keep credit flowing and the economy humming. RBI decisions may seem distant, but they hit home fast. For borrowers, a 25 basis point cut means lower EMIs on home, car, and personal loans, freeing up cash for other needs. For businesses, cheaper loans make it easier to invest, expand, and hire, fueling growth and job creation. But there's a trade-off. Savers may see lower returns on fixed deposits and savings accounts. The RBI's bet is that the benefits of more borrowing and investment outweigh the downside for savers. Lower rates spark a virtuous cycle. More spending, more jobs, more confidence. When people feel secure, they spend more, driving further growth. The direct impact is on your EMI or deposit rate, but the bigger goal is a stronger, more dynamic economy. The hope higher growth and jobs will more than make up for slightly lower savings returns. The RBI's actions aim to lift everyone, not just a few.
Despite the positive domestic outlook, Governor Malhotra warned that global risks remain. Central banks abroad, especially the US Fed, could raise rates, pulling capital out of India and pressuring the rupee.
A weaker rupee makes imports costlier and could reignite inflation. Geopolitical tensions and oil price spikes are other threats that could disrupt growth.
That's why the RBI is staying vigilant, keeping its stance neutral and ready to respond.
Policymakers are optimistic but not complacent. They know global shocks can hit fast. Prudence is the watchword, even in good times. In summary, the RBI's December 5th decision is a masterclass in balancing growth and stability. The 25 basis point cut builds on strong growth and low inflation, aiming to keep the momentum going. Liquidity measures ensure the benefits reach the real economy, not just the banks. The neutral stance and global caution show the RBI isn't taking anything for granted. The goal: more jobs, stable prices, and affordable credit for all. For India, it's about cementing our place as a fast-growing major economy. The RBI's latest policy is a thoughtful step forward, seizing today's opportunities while staying ready for tomorrow's challenges.